Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, it's time for our weekly look at the US stock markets. We're going to be using the SPY ETF as our proxy for the S&P 500. We're going to be looking at the PCC and we're going to be looking at the VIX as well. Now, first things first that I want to start off on is last week I appear to have triggered some people in the comment section who took grave exception to me having a bullish count in the spot market as a primary. So I need to touch on that first. You are entitled to disagree with me, that's fine. I would suggest not being a prick about it in the way you do it, but that's totally up to you how you behave, it's your life. But what I will say is, just because I label something primary in the short term, long term or whenever, it's purely because based on my understanding of Elliott wave and the count I've come to conclude is that currently has the greatest probability of being right. It is not a 100% guarantee. It might not even be a 51% guarantee. It might be a 50.00009% guarantee. If you take my point, it's not a guarantee then, is it? My point is, I have alternate counts which are bearish. We're going to go through them. I fleshed them out a bit more since last week and we'll talk about those today. Alright, but the point being, I am 100% open to the idea of the market going lower, in fact even much lower. Okay? But I would suggest that you be open-minded enough to consider the possibility that the market could go higher, as doesn't matter, regardless of however strong your fundamental arguments are for the opposite to occur, because it's only when fundamental arguments are most in favour of our bias that the market reverses. Does it all the time. I've been here long enough to tell you that from personal experience. Most recent example was the COVID lows. If you can just take your mind back to how bearish people were at the lows and how it was the end of the world, and no amount of stimulus or fiscal help or monetary easing was going to save us. This time it was different. It wasn't, and the market pivoted. So I'm not saying that the market has pivoted and we have to go higher and that has to occur. I'm simply saying try and keep an open mind. As unlikely as it seems, it can happen and does happen, and I'll keep an open mind that the market could fucking plummet. Okay, so that's the first point I want to cover, which is we're here to analyse the markets, not to fall out over it really at the end of the day. So let's now press on, and the first thing I want to do is I just want to remove all the Elliott wave count. We're going to consider, to begin with, without stressing ourselves over Elliott wave, where we're likely to find support if we take out the June lows and head lower. So most obvious place I can see, looking at the fixed range volume profile here of this impulse to the high, we've got our point of control, we've got major long time support. Let's bring up our LT support and resistance folder. We've got support at the previous highs of the February 2020 high, which splits on our point of control this demand zone here, moving up to a level, back finding buyers, up to a level, back finding buyers. We've got two support levels here, and we've also got our 50% retracement. Let's switch off of log for a moment. Our 50% retracement at 351.23, our golden ratio at 320.85, and our overrun for the 65 at 312. So two support levels, point of control of all of this move up, obvious demand zone, okay, all waiting here. 250-day exponential weekly average crawling through this area as well. Likely to start rolling over if we come down again, but we could come down and meet a downward facing moving average in this area as well. That's possible. So all of that, if we do come lower, this is where I would expect us to find some serious support. Now how we find it and what it means longer term we can discuss in a moment with our alternate counts. But coming down here, if we do come lower, seems to make logical sense, and it's where I would expect the market to find some serious support. Okay, so there you go. If you want to look at those as potential targets, if you are on the bearish side in the short term, 338.84, 323.32 as structural support levels, and then anything ranging from 351 down to 312, it's somewhere in this region likely place to find a low. Okay. While we're here looking at the volume on the weekly time frame, we can see volume is declining with this sell-off. This is a little unusual, as previous sell-offs have actually had support from volume. Okay, we've increased into the sell-off. We can see here we increased into the sell-off. We can see here we increased into the sell-off. Here we've been losing push down on volume for the sell-off. Now that could just be a shift in scale if you're being very bearish and we're getting a slow start, or it could be a sign that we're actually not really entering any form of major bearish push down. You can interpret it either way. I would say that the recent move down here has been supported by volume relative to the prior bullish week. So if we look at bullish move here, we can see decline. Oh, excuse me, clicked on the wrong tool. So this move here, we see these four declining green bars on the weekly, but we see that the move down does have support from volume here. The push down is supported relative to the move up. So, like I said, you can interpret either way. What I do find odd about this sell-off is, we'll see when we come over and have a look at the VIX chart and the PCC later, is there hasn't been any concern while this has been happening. Essentially, VIX has not picked up. It's actually declined with price, which suggests that it's not the beginning of something really nasty. But things are complicated at the moment, and sometimes making such assumptions could be a mistake. So keeping an open mind, it could be bearish. It has support from volume, but it doesn't appear to have, for any reason, created the volatility one would expect with a downward move like this. So there you go. Now let's have a look at our indicators. So on the weekly, we had that bullish divergence in oversold conditions on the RSI between these two lows here. That divergence, I would argue, has now been satisfied with this counter trend move, being bearish minded for a moment. So we've seen a move back into neutral conditions on the RSI, and that was likely that divergence playing out. Okay. As we come down to the daily time frame for a moment, we are back in oversold conditions on the daily time frame. Now the market often doesn't spend much time in oversold conditions on the daily time frame. Okay, so if this is a free wave move down A, B, C, lower into this zone, then we may have completed the first wave, the 1, 2, 3, 4, 5A, or the A itself may have been completed here, and now we're going to rally up before rolling over again. In the bullish count, of course, this would be a continuation of a rally into a third wave, and we'll see new highs. So we'll talk about those in a moment. OBV continues to trend downwards on the daily time frame, and we actually got lower lows with no sign of divergence with this move up off of the high. So that's because this is an accumulator. There simply hasn't been the bullish volume on daily closes, as we've seen with the increase in bearish volume here, to shift this around to positive at the moment. So that is not a great sign for the bulls, admittedly. So we'll keep a little trend line on that. But some kind of reversal here, I think, is likely. MACD has shown a higher low with this move up. If this is a low, so we've got a low, a higher low off of that divergence, and then we've got the first higher low off of a potential move up. So we'll have to wait and see how that turns out as well. So now that we've covered that, let's look about how we're going to get down here if we're coming down here. So having fleshed out the bearish counts, let's look at the alternate first. And just looking at the count from the high, dividing these as a series of zigzags. There's one, there's another, and this will be a third, and it's a series of zigzags. The X came back here beyond the W. I can live with that. It's not ideal, but I can live with it. It's not a problem. It's not breaking any rules. Coming back above the X here, it would have ceased to look like a sharp correction at that point. It would have simply started to look like a flat, or it would have started to look like a sideways combination, perhaps, if we're labeling it in that way. But it did not, so we are still in a downward trend of lows, highs, lower lows, lower highs, lower lows. If we're taking this pivot, this is still a lower high than this one. So looking at the way we counted it, W, Y, this is the next move down, so this is the major pivot, this is a major pivot, this is a major pivot, this is a major pivot, this is an ABC within it. So we can't necessarily look to that as reversal, because like I said, it's a subwave. not a major pivot if this count is correct. So we are still going low, lower high, low, lower high, lower low. Okay, that's one way of getting down here, series of zigzags. The next way of getting down here, which is much more bearish, and I've called it major bear, should probably call it kernel bear or general bear, because it definitely outranks other bearish ideas. But either way, all these are zigzags, but they're zigzags in an expanding leading diagonal. Now that's some seriously bad news if that's the case, because what this means is we're going 1, 2, 3, 4 and 5 into an A, right? And that means, so the 5 would have to be longer than the 3, 3 would have to be longer than the 1, 4 would have to be deeper than the 2. So far, the 4 is deeper than the 2, the 3 is longer than the 1, so we've satisfied 4 out of 5 conditions already for this to be correct. I'm not keen on the subdivision in some of these zigzags. I prefer them as X-waves as opposed to true zigzags inside of 4s and 2s and 1s and 3s and all that. So, but you get extended C's occasionally, you get extended A's occasionally, so I'm not going to, be annoyed, get worried too much about it. So this could be into oversold conditions A. This could be B, extended C down here perhaps to get us into this demand zone. But once we get down here, it's not the bottom, it's just the beginning. We get an A. Now, completing a diagonal pattern, a leading diagonal, the retracement most of the time will be deep, looking at 78.6 to 89%. Or at least 61.8% we would normally expect off of a diagonal. It's not always the case. You can have shallow retracements, it's just deeper retracements are more common. So if we do get a retracement, we're likely to come back up to major resistance, right, which will support these highs, these lows, something like that. Right, so we'll get a big rally and everyone will be screaming the lows in. Right. Now, you'd be a fool to miss this when it happens anyway, bear or long-term bear or short-term bull, because it's a huge relief. Opportunity to trade to the upside, load back up on short positions if that's your the count you're looking at. So then you'll get a big retracement, but then, having led with a diagonal, it's likely we'll get an impulse to alternate corrective forms. Now, I know they're both motive forms, so I shouldn't say corrective forms, but it's a correction, so some form of alternation would be welcome. So if we come down here, we could be a diagonal again, but having had a diagonal, let's give it the benefit of the doubt and say we get an impulse to get our C, sorry, and then you've got something really nasty, where you're going to see more than 50% of the United States equity market disappear. 50% of the United States value of all of its companies evaporate. Now that's a bad situation. There are some people out there who are talking 70, 80, 90% declines, but I think they're just addicted to bear porn and they can't help themselves. I'd argue any world in which that's happening to the United States, you got way bigger problems than equities tanking. Way bigger problems, because for all those who've been talking about the rise of China, for example, and the rise of competition to the United States, when you look at the economic reality, when you look at imports, exports, raw material dependencies, trade balances, and you look at population demographics, China is not going to outfight, outcompete, outwork, or outinvest the United States of America anytime soon. It's just not going to happen, in my opinion. Now, if you disagree, that's fine. But when I look at the fact that China's population is likely to halve by 2050, just based on the mathematics of demographics projected into the future, I don't see a more competitive society. I see a less competitive society, and with its dependencies on imports of basic energy and natural resources, and food even, you're talking about a country which does not have the advantages of the United States, in my opinion. So those calling for the collapse of the United States, I think that's very premature. All empires rise and fall. I know I'm British, but at the end of the day, I think it's a little premature. I think that with the entire world's capital available to go somewhere, to go looking for opportunity somewhere, you'd probably be best looking at the United States. I feel that the US has a lot more to offer in that regard. So it's just a personal opinion, and I'm not some kind of I'm not even sure what the term would be. A massive lover of America, or I'm not a hater of America or a lover of America. Either way, I'm just trying to be practical. Either way, that's a fundamental argument. Let's not go down that road. But that's why I would probably argue against a 90% collapse of the United States equity markets. 50% is more than enough. Either way, these are all your bearish situations. So there you go. Plenty of evidence to show you that I am very open-minded to the idea of the market going lower. I have prepared for it. I am, and I can easily position for it. However, for the meantime, my primary count is still bullish. So there you go. Intro over with. Let's now come over and have a look at that count. Switch off some of this stuff. Switch off the moving averages, and let's zoom in and have a look here. And let's bring up our bullish count. Alright, so simple as this is a 1 and this is a 2. Right. And we're going to reverse imminently, or maybe one more little flush down before we do. But we're going to reverse imminently and head higher. So now let's come down to the 4 hours so we can get a little bit more detail here. Let's bring up some local support and resistance levels, and let's bring up some local supply and demand as well. So looking at this situation currently, we have 1, 2, 1, 2, 3, 4, 5, 3, 4, very small and brief fourth wave. I know, not beautiful, not in nice scale with wave 2, but I've seen it plenty of times. 1, 2, 3, 4, 5 into 1, and then we've got A, B and C down into a 2, a zigzag into oversold conditions. So come back to support at 390.38. This is the level I pointed out previously, into demand, which I pointed out previously, and now we're going to bounce from here. If we have a look at what we've retraced from below, we've come to the 61.8 golden ratio, pulled back to the golden ratio, into prior volume, into price support, and bounced. No big surprise. Now, like I said, bearish scenario suggests that this could be 1 or A into a retracement before heading lower. Bullish scenario says this is a completed zigzag and we're going higher. That's it, guys. That's how simple it is. Invalidation at 362.16. Come down below this. This bullish count is incorrect. So, bullish caps on now for the moment. We get an impulse out of here and a 3-wave pull back. That's your entry point. You can take one further move up and back on a shorter time frame to use the standard trade setup, or you can just treat this 1, 2, 1, 2 as standard trade setup, the STS that I teach on the Patreon, and this gives you 1.45% risk. Depends how much higher this wave 1 comes up and how deep the wave 2 comes back. It could be bigger. Alright, but managing risk into the entry on the long side, if you are of a bullish mindset, that's what you want to be looking for here now, because this could be the beginning of a 3. Worst case scenario, you're wrong, this comes up in 5 and it's ABC, in which case you're still going to be in profit. Right. So talking about short-term trading in these volatile conditions, even down to smaller 5-minute, 15-minute, 1-minute time frames, totally legit, I'd argue, under these conditions, because of the uncertainty out there. Point being, you can pivot in an instant. Okay? You don't have to stick yourself to your bullish view or to your bearish view. And this seems to be something that is lost often on the comment section on the YouTube channel, where people say bulls are going to get wrecked. Why? Bears are going to get wrecked. Why? You don't need to stick to anything. You simply pivot where you need to. Okay? And if you're managing risk on your entries, the market will stop you out and remove the risk for you. Right, so anyway, enough moaning and bitching about what people say. Perhaps I'm being a little oversensitive about it, maybe, but either way, whole point of what I do is to try and help and to try and educate to some degree and try and keep an open mind. So there's your bullish scenario. We've had 5 waves up, not beautiful, but you tell me what's beautiful from an Elliott wave point of view about any of this. Right, not much. So 1, 2, back to the golden ratio, back to demand, back to support, into oversold conditions, bounce higher. We want to see 1 and 2 on a smaller time frame before heading up. If we fall down lower from here, we will look for a reversal at lower conditions up until the point of invalidation at 362.16, at which point any retracement will be viewed with bearish eyes instead of bullish eyes as a potential to move lower. But once again, we would be trading off of the idea of a standard trade setup, looking to trade retracements, because we don't trade breakouts. Trading breakouts is a bad idea. There are examples of it all along here. So let's say you were in a bullish mindset. Right, so here's move down, back to high resistance, move down, back up, breakout. You buy the breakout, what happens next? Flush down. Alright, so we wait and buy retracements. Down, up, retracement. What happens next? Price moves higher. Give yourself some margin of error, give yourself some room to breathe. Alright then, so anyway, that's the bullish counts on the shorter time frame. If we just remove that local support resistance supply now, let's have a look at let's push this into the correct folder. Now let's have a look then at the bearish counts very quickly on the shorter time frame. So, like I said, this could be the completion of A, B and C. Anyone out there with a pair of eyes in their face would have seen this. Right, now every time I see this line on a chart on the YouTube channel, I always get a little triggered, because a monkey can see this. Right, a blind monkey with dementia can see this fucking line. Alright, you're not getting an award for spotting a downtrend. Okay, we know we're in a downtrend. Lows, lower highs, lower lows, lower highs, right? So we've come back to resistance, and that's what we're looking for. That's what we're looking to see now that we've come to resistance. If we can find support before moving back up, this will be something we want to watch if we break to the upside. Okay, so support of the bearish idea from a fundamental perspective of a downward trend continuing. We've come back to sloping trend resistance. That's what I would call this. Right, and now we're heading lower. So if that's the case, A, B, C looks correct. It could also be, if we want to be more bearish, it could be 1, 2, 3, 4, 5, A, B, C, and go deeper. Okay, that's that idea of the WXYXZ, and then you've got the really scary idea, obviously, of the pitch of the leading expanding diagonal. Now, if this is the case, it's A, B, C. Okay, because we are going to come back down to the trend line. We're likely going to fall short of it though, because that tends to be the behaviour of an expanding diagonal, whereas a contracting diagonal tends to overthrow the trend line. A expanding diagonal tends to fall short of it, but it must still be longer. The 5 must be longer than the 3 in this circumstance. I don't know why I've got that minute degree count there. Let's just delete that. Save the chart. So there you go. Now let's come over then to wrap things up. Let's come and have a look at the PCC quickly. And people have been asking me how to set this up. It's really super duper simple. We go to the put to call ratio, equities plus indices, CBOE, right? We introduce a 250-day moving average, and we introduce a 60-day exponential moving average onto the chart, and then we simply remove the price data and then place the levels around where we have the highs and the lows, label it thusly, and that's all I've done. It's that simple. You can label it any way you want, you can set more levels on it you want, but that's really just how simple it is to set up. Okay, so there you go, a bit of free content there. We've come back up to this downsloping trend line that we've seen from all these previous highs. In fear and panic, we've reversed, but now we're heading back up with this little sell-off. If we, having done this, come back down and break this 250 moving average, we can see how we often come back to it for support, but in our initial move down, our extended move down from the high, we break it and then we tend to stay somewhat below it, right, with the occasional peak back above it. But then once we're below it, the 60s through the 250 and tends to move lower. Once the 60s tested it and moved above it, it tends to stay above it on the way back up. So it's not the greatest signal by any stretch of the imagination, but it would give us confidence if we came down below it and then started this downward trend. We'd expecting to be seeing the market do the absolute opposite, to be going up. Okay, so we've come back to that trend line now. There's nothing stopping us from doing that like we've done before. Okay, shit could get out of control really fast if it's a more bearish scenario, but from a historical perspective, we seem to be putting in another market low. Now when we come over to the VIX, this is a little peculiar, because like I said, we've had this sell-off now going on for a fair old while, and volatility is suppressed. Long-term trend coming up, there's no doubt about that. Since 2017, I pointed it out several times, but recently a downward move in volatility. Not really in line with what we'd expect to see, I'd argue. So we'll have to wait and see what happens, but for the moment volatility remains suppressed. I would have expected some kind of capitulation move into at least this prior territory that we've seen many times before for a market low, but we got into it just, maybe that was enough. Okay, so there you go guys, I'm going to leave it there. I think I've said everything I want to say. The bullish count, unless invalidation occurs, is still the one I'm backing for the moment. I'm totally open to it being wrong. Let's just clarify, let's emphasize that one more time. We then have our major bear, end of the world scenario, and then we have our alternate series of zigzags lower. Alright guys, thank you very much for joining me on this technical analysis of the SPY. I hope you've enjoyed it. If you're new to the channel and you've liked what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below. If you're not following me yet on Twitter, there's a link in the description box below as well. And as always, huge thank you to my Patreon subscribers. If you're interested in joining the Patreon, head over, follow the link in the description, head over, have a read of the tiers, and feel free to sign up. You get an awful lot of stuff for doing so. A whole bunch of education content, including my Elliott Wave series. You also get weekly live streams which go on for hours, and I'm always at the beck and call to the best of my ability to those members on the Discord to answer any questions as and when I can. So there you go guys, take care of yourselves, and I'll be back with you as soon as possible. All the best, bye bye.